Welcome to today's show. I am your host, Eric Darnley Small, and this is somewhat of an impromptu episode of the show. I think on my last video, I kind of signed off for the year. However, something has been on my mind for some time, particularly after the election is over, and it's something I want to talk a little bit about because I've been seeing this more and more online, and I think it's important. If you like today's video and find it helpful, please consider liking us and subscribing to the channel. Click the bell and you'll be notified of any new content as I upload it so that impromptu videos like this don't catch you by surprise. In addition, if you've been to this channel before, you know I will reference other material. I encourage everyone to go and take a look at my homework, take a look at the things that I reference so that you can also become more knowledgeable and more informed about these subjects as well. So let me get into it. I hope that, as always, that this will be a relatively short video, but I do try my best. And today it's what recently happened with the yield curve. That's today's show. And I want to sort of answer the questions, what the hell is a yield curve and why should I care? I think that that's a fair question. And this is a part of a series called The New Normal that I've decided I'm going to call it The New Normal. But it is something that we're going to have to deal with. Some things that have never happened before. It is new. It is the new normal, as I like to call it. And it involves the first half of Trump 2.0. I talked about this on the last video a little bit. And I talked about this so that I could sort of alleviate a little bit of the fear that I'm hearing a lot online, particularly on the left, about Donald Trump and what he's going to do in his first days and what he said he's going to do. And I have, to some extent, sort of tried to express skepticism about what Donald Trump is going to do. Just a reminder, this is what Donald Trump has to do. He says, he would, in my last video, I went through all the things that could greet a President Donald Trump on day one of his presidency. While he might have a list of grievance-related and destructive items on his plate, he will have to deal with what President Joe Biden leaves him. Here are some of the items he wants to do: deport 11 million migrants, cut taxes, assemble a new cabinet, dismantle Obamacare, begin prosecutions of his enemies, lift the debt ceiling, enact tariffs, purge the government of all non-loyal Trumpers, fill the government with Trump loyalists, and pick a fight with the Fed. That is a lot to do on day one. And I want to also express, as to the first and last items, many economists agree deporting 11 million or more immigrants who do low-skilled jobs will cause severe damage to the economy and could cause inflation. To make matters worse, it appears as if the new president would get an economy that is rather weak. Economists have been looking at an indicator that has been right for decades to gauge the health of the economy. The indicator is setting off alarm bells. Folks may remember an 07-08 market crash if they're old enough. If not, check out the movie The Big Short and or the docuseries Frontline Inside the Meltdown for the history. I, of course, in Mastodon will have links to those videos, or at least to the Frontline one. It is incredibly important. It is extensive. It goes beyond the what happened in '08. It actually talks about what has happened since. Important for you to know. Both the movie and the docuseries follow several characters, most notably Michael Burry of Scion Capital. Burry was one of the few investors that saw the housing bubble forming and was able to short stocks when the collapse eventually came. He made a fortune for himself and investors. Burry said, all you had to do was look at tried and true indicators to see what was on the horizon. So all of that to say that what's old is new again. And for the savvy investor, for the savvy person who understands the economy, they look at certain indicators that indicate what the stock market does, can give you an idea of how the economy is on the whole. And what should investors worry about an inverted yield curve? A recession could be on the horizon. That's the point of today's video. The inverted yield curve. In October, Bram Berkowitz wrote an article in the Motley Fool entitled, "This reliable recession indicator recently did something for the first time in 793 days, it could trigger a big move in the stock market. The article is one of a series of similar articles I've been seeing. It warns the yield curve has been inverted since July 2022, quote, marking the longest period of inversion ever and beating the previous record of 624 days in 1978. Quote, in early September, a closely watched part of the curve began to uninvert, specifically the yields on 2 and 10-year U.S. Treasury bills. Typically, a recession occurs not long after the yield curve uninverts. The yield curve officially uninverted in early September. According to Barron's, each of the last 4 recessions, which began in 1990, 2001, 2007, and 2020, all kicked off about 3 to 6 months after the yield curve was uninverted. Stocks tend to get hammered during a recession, with the broader market S&P 500 falling by more than 30% on average in the last 10 recessions. So I want to be clear here. I am not saying that we're on the brink of a 2007, 2008 market crash and collapse of the economy. What I am saying, however, is that the yield curve is telling us something. And it is important to look at what it is it's saying. And I'm going to go into what the yield curve is and what a yield is, because there was an excellent video from 4 years ago on CNBC. It gives us a little history on the yield curve. What is it? How accurate it is? What do investors fear most? How should investors think about this? This is a clip. It's entitled, How the Yield Curve Predicted Every Recession. You will, of course, find it on the Mastodon, as I indicated earlier. Take a look.
What is the yield curve all about, and why is everybody talking about it? The yield curve is just a graph showing the relationship between short-term and long-term interest rates of U.S. Treasury notes. Usually, the short-term rate is lower than the long-term one. But if you are lending money to the federal government, which is essentially what happens when you buy a Treasury note, you are taking a bigger risk by letting the government have your money for a longer period of time. So you're going to want a higher interest rate to compensate you for taking on that risk. But sometimes this relationship changes. If the two rates start getting closer together, that's called a flattening yield curve. If the long-term rate dips below the short-term rate, that's what we call an inverted yield curve. And the market is concerned about it.
The reason why we watch the yield curve so closely is that it has been an incredibly accurate predictor of recessions. Every time that yield curve has inverted, the economy eventually has gone into a recession.
You can see that predictive power on this chart. It shows the difference between the long-term 10-year and short-term 3-month Treasury rates. When that line goes below zero, it represents an inversion. And those inversions have preceded every single U.S. recession going back 50 years. But it wasn't until the 1980s when policymakers started to catch on.
Back in the late 80s, the yield curve was being referred to as a possible leading indicator of the economy. And I was asked by my bosses whether there was anything to this, whether you could prove statistically that there was a relationship.
Arturo Estrella is one of the economists who helped discover the predictive power of the yield curve while working with a colleague at the Federal Reserve Bank of New York.
By early 1989, we were not only seeing the predictive power in general, using historical data, but we actually saw an inversion. So at that point, it seemed to be indicating that there would be a recession about a year later. And our presentations were met with a lot of skepticism. But the recession started in 1990, so it was almost a perfect prediction.
Estrella's work focused on the difference between the 3-month and 10-year interest rates. But many in the finance world also watch the difference between the 2-year and 10-year rates closely. Think of 2 and 10-year bonds like car and truck lanes on a highway. Normally, when the 2-year rate is lower than the 10-year, traffic is moving along smoothly. Cars in the 2-year lane are moving faster than trucks in the 10-year. But the Fed raises its benchmark rate if they think things are going too fast in the left lane. Imagine the Fed like the sheriff, enforcing the speed limit. Raising rates puts a damper on the economy, slowing down those in the fast lane. The short-term interest rate is more closely tied to the Federal Reserve funds rate. and it's more connected to how the economy is expected to perform in the short run. The long-term interest rate is usually higher. Investors are usually paid more to lend for a longer period of time. As the economy grows, you need the money you lend out to be worth more when you get it back. But the long-term outlook for the economy may not be changing much. Those trucks chugging along may even speed up a little. Well, you know what happens when the trucks in the right lane are going faster than the cars in the left lane. That's the inversion we talked about earlier. And there's a good chance there's traffic ahead. It becomes more expensive to borrow for the short run than in the long run. All of this affects how people lend and the risks they're willing to take. That can help drive a recession. The unconventional traffic pattern may get people to start changing lanes, adding to the complexity and eventual traffic.
Whenever the yield curve uninverts or re-steepens, people tend to be happier, more optimistic. If an inversion is a negative sign, then necessarily an uninversion would be a positive sign. And that may make intuitive sense, but what you'll see is if you look at a graph of inversions and recessions lagging thereafter, the yield curve typically uninverts even before a recession begins. You'll have this inversion with short-term rates exceeding long-term rates, and then it's not uncommon to see that correct itself even in the span between the initial inversion and the recession.
In other words, this re-steepening has proven part of the yield curve's normal predictive behavior. So the inversion is really just the beginning of the recession warning, but the curve can do all sorts of things as the recession it predicts comes about.
So that is the yield curve. A little bit of history there, a little bit of information there for the investor. So what are my final thoughts here? 2 weeks ago, I would have been worried about this. Now that the election is over, I'm less so. Like any other president, Trump will come into office thinking he can change Washington, and he'll be hit with whatever the previous president left behind. The Motley Fool article goes on to say, quote, while the yield curve inversion's reversal has been reliable, it hasn't always triggered a recession, such as in 1966. Historical data is great to use for research and to get the idea of what could happen, but it can't always predict the future. For me, while things look good so far in the economy, we cannot be blind to what's happened in the past. Most on Wall Street did not see the Great Recession coming. My advice is investors should look at their portfolios and prepare for what could happen. Consult your financial advisor. Look at what Michael Burry and Warren Buffett are doing. Their portfolios become public knowledge, and Buffett releases a note to investors every year with advice on what he sees and what his opinions are. You can also track their portfolios using sites like Quiver Quantitative. For the investor, forewarned is forearmed. So that is my overall view of this. Number one, that Donald Trump, who has come in breathing fire and brimstone, is going to try and do a whole lot, but he's going to be hit with whatever the economic conditions look like. And if it's anything like what happened with COVID, he's going to have a very hard time of it. In addition, we need to be prepared if you have investments or if you're an average everyday American with a job, be prepared for what is coming. It's the holiday season's coming up, and people are going to tend to want to spend a lot of money, and that may not be very smart if we end up in recession and if the economy starts to bottom out. So again, forewarned is forearmed. Thank you for joining me on this video and all videos going forward. And you will see me on the next one, probably before the end of this year, but certainly in 2025. Have a great day, everyone, and happy holidays. Hey there, fantastic viewers. Eric Darnley Small here, and I hope you're loving today's episode of What You Missed. You've reached the end of today's show, but don't worry, there's more show coming up. If you're watching this on YouTube, please click the bell so that you'll be notified when more content is available. You can also help the channel by clicking the like and subscribe buttons. It helps the YouTube algorithm find new viewers so that I can keep bringing you all this incredible content you enjoy. But wait, there are more ways to support the show. You can make a contribution through the show's PayPal, which goes a long way in helping produce even better content for you. And consider becoming a part of our growing community by joining our Mastodon site at mastodon.vtip.me/@whatyoumissed for more engaging discussions and exclusive updates. And here's something you won't want to miss. Mark your calendars for our live show streaming on YouTube and stream.vtip.me Monday mornings, 10:30 a.m. Eastern Standard Time. Your support means the world to me, and together we're making what you missed the best it can be. Thanks for being a part of my journey.